Alright, let's go ahead and get started. I'm going to talk today about working capital management. Hopefully I'll be able to shed some light on that, in addition to something that may help you with your managerial economics discussion about how trade credit is used. We'll talk a little bit about that at the end. But working capital management, if you remember from, I think, class 1 or 2, we talked about working capital as that excess of current assets over current liabilities. And that, on the one hand, gives the company a little bit of cushion if you need some money to buy some stuff. On the other hand, we looked at the aspect of that where that's just money sitting around, and it could be used to generate more free cash flow and more value. So we're going to dissect that and think about how we want to find the optimal level of working capital. All right, we're going to start with a little free cash flow review and working capital review. I'll remind you how we calculated working capital. It'll be good review for the exam, which is going to be in 2 weeks, and it'll warm us up for the review that's going to be in 1 week. And it'll also help us think about how this working capital discussion fits into the value of a company. And we'll talk about working capital management, like how do we manage those current assets and those current liabilities in a way that helps us. We'll use a metric called the cash conversion cycle, which tells us how long it takes for cash to work its way through those current assets and current liabilities. We'll talk about trade credit, which is the one thing we were talking about earlier. If you pay early, how much of a discount would your suppliers give you? And if they're charging interest, how does that affect your working capital policy? And then we won't talk about commercial paper. I forgot to take that off, but that relates to working capital. We won't spend any time on it, though. All right, so let's just review our free cash flow calculations. Remember, we're calculating free cash flow, which is going to determine the value for a company. And we're going to discount those free cash flows based on weighted average cost of capital. We're concerned in this class with the top part of this. We have sales and we have costs that we need to incur to generate those sales. And then there's this part we talked about, this required investment in operating capital. Does anyone remember what that is and can explain that to us? It's required investment in operating capital. So we're a company, and suppose we're generating $10 million a year of free cash flow. Or, well, not free cash flow. We're generating $10 million a year of what we call net operating profit after taxes. Remember, that's a metric we liked. But in order to do that, we need to buy a new building. We need to invest in inventory. And in 1 year in particular, suppose we spent $3 million buying buildings and inventory, stuff that did not affect our sales revenues, did not affect our income, but it did decrease our free cash flow because we needed to invest in that capital in order to get that cash. So let's break down this steps. Do you all remember this diagram when we talked about free cash flow? All right, I don't know if that's a happy look or a sad look, Alexandra. All right, but I'm glad you remember it, kind of. So we want a component of the free cash flow, which we're going to call net operating profit after taxes. And the starting point with that was our earnings before interest and taxes. And then we take out taxes. And we like this earnings before interest and taxes because it's a figure that assumes no debt. We don't want a figure that has already taken out interest payments because we want the cash flow that's going to go to both the debt holders and the equity holders. So we like earnings before interest and taxes, and then we take out taxes, and that gives us our NOPAT, net operating profit after taxes. We are ever so close to calculating our free cash flow. All right, you see this net operating profit after taxes minus net investment in operating capital. All right, someone, can you remind us now how to explain it one time? Just summarize that back to me. What is this minus net investment in operating capital, and why do we need to take that off to get from...
It's the total net operating capital the current year minus the total net operating capital last year.
Yeah, Patrick, but what does that mean intuitively? Why do we need to subtract that figure from NOPAT to get our free cash flow? How was that, Mallory? No. Okay. So, help us out, Brian.
So basically, it's your net investment in your operating capital. So that's basically your operating capital is how much it's going to take to function properly, efficiently. So it's you're subtracting that against your operating profits because, like in step 2, it's current assets and current liabilities. So you want your net variables together.
Okay, so it's how much we're investing in our company that's not going to show up in the income statement. It is our investment in operating capital. All right, as I mentioned earlier, we had to buy a building. We had to buy some inventory. That's not going to affect our NOPAT. It's not going to affect this figure, but it is money that is not going to our investors. So we subtract it off. Remember, there are 2 components of this operating capital. One is the working capital, and the other is the operating assets. And working capital. What is working capital? Your textbook, I guess, calls it net operating working capital. I'll just call it working capital for simplicity. What is working capital?
Current assets minus current liabilities.
Yes, so our current assets minus current liabilities. Our current assets might be inventory, accounts receivable, cash. Our current liabilities might be accounts payable, is the big one. Accruals is another one we'll talk about. So what is the difference between current assets and current liabilities? And we're going to be concerned with the change. All right, did that increase? All right, did we have to put more money in inventory to keep generating that cash flow? If we did, then that's going to decrease free cash flow. And then once we have our working capital, we're going to add our long-term assets, buildings, factories, and we're going to see how much those 2 things put together, how much did they change. And that's going to give us our free cash flow figure. And what we're going to do tonight is break apart this working capital figure. What can we do, essentially, to make that figure lower? And is it responsible to make it lower? And when we do make it lower, how that generates more free cash flow. It has less of our money tied up in inventory, less of our cash just sitting around. All right, I put some figures here just for review. Free cash flow, the amount of cash available from operations to all investors after making necessary investments to support operations. I mentioned necessary investments to support operations, like suppose we had to buy a building. That doesn't affect a NOPAT, but it does decrease free cash flow. Suppose also, more specifically, we'll talk about things like this tonight, suppose we had to buy a bunch of inventory, just to keep it on hand. Company's value depends on the amount of free cash flow it can generate. So if we can do things with this working capital management to generate more free cash flow, then we're going to be happy. If you can come into a company, look at their accounting statements, look at their inventory, look at the way they're managing accounts receivable, and decrease those, decrease the working capital and generate more free cash flow, they're going to say, yeah, you're worth the $600 an hour consulting fee that you're charging. Thank you. Or, I'm so glad we brought in the Mercy College MBA for the summer internship because we were able to identify this point which could add a little more value to our company. And we talked about this figure of NOPAT, which assumes no debt. All right. And then we talked about this idea of working capital, which Alexander pointed out is current assets minus current liabilities. And then we're going to add operating capital to that. And we're going to measure the change. All right, current assets. Again, this is just kind of put these slides up to review, to make sure we're clear. Current assets include things like cash, inventory, receivables. Little footnote about what it does not include, like short-term investments. Current liabilities includes things such as accounts payable and accruals. Little footnote about what it does not include, such as notes payable. And then to get in working capital, we subtract operating current assets from operating current liabilities. Okay, so that's a quick review on free cash flow, quick review on how working capital affects free cash flow. Does anyone want to stop me and ask any questions on that before I move on? Just working capital, we did it in class 2 or 1. Current assets above current liabilities. We talked about how when that changes, it affects free cash flow. So, the main thing we're going to talk about tonight is working capital management, how we manage those current assets, inventory, receivables, accounts payable. Working capital management is defined this way. Let me read it to you and then we'll break apart what it means. Working capital management includes both establishing working capital policy and then the day-to-day control of cash, inventories, receivables, accruals, and accounts payable. So first let me tell you what working capital policy means. Working capital policy is the level of each current asset. How much cash do we want to keep on hand? How much inventory do we want to keep in our warehouse? How much do we allow in our accounts receivable? And how we're going to finance these assets. All right, we want to increase our inventory. How are we going to pay for that? Are we going to have a bunch of cash lying around that we used to pay for that? If not, are we going to borrow some money? Are we going to borrow money short term? Are we going to borrow money long term? So working capital policy is how the level of each asset and how we're going to finance the asset. And then our main topic for tonight of working capital management is establishing that policy and then the day-to-day control of cash, inventories, receivables, accruals, and payables. So you as the financial analyst, the financial consultant, the accountant, you would know the policy of your company. How much inventory do we want? How much cash do we want to keep lying around? And then you would think about controlling that on a day-to-day basis. You might go talk to the inventory folks and say, how much inventory do we really need? Do we really need $6 million worth of inventory tied up? Or can we cut it down? Do we really need this much cash sitting around? Or can we decrease it? And if we decrease it, we're going to get more cash to our owners, to our investors. All right. In terms of working capital management, let's think of two terms, two policies, two ways of managing working capital. One is called a relaxed policy. The other is called a restricted policy. In a relaxed policy, a firm will hold a relatively large amount of each type of current assets. We'll hold a lot of cash, a lot of inventory, we'll allow a lot of accounts receivable. Under a restricted policy, a firm would hold a minimal amount of each current asset. Very little amount of cash, very little amount of inventory, accounts receivable. So, first question, of these two policies, which is likely to generate more free cash flow and more value for the company? I've heard one guess. Anyone else?
Relax.
Relaxed. Oh, okay. All right. So I've got one vote for restricted, several votes for relaxed.
Restricted.
Restricted? Okay, explain it to us, Bill. Why is restricted going to generate more value for the company?
When you're restricting things, you're kind of running very lean. So if you're buying inventory, you're only having inventory for what you need. So you're not buying all this excess inventory that you might not be using this month or next month, or you're just running in a lean inventory. And then for expenses, you're not kind of going crazy with things. So you have this money. Let's say you have $1 million, but maybe your operating costs are only $50,000. But you have all that excess cash. It's kind of not. being free, it's not tied up in stuff that can't turn around quickly.
Okay, so you're running a lean operation, so it is correct. A restricted policy will generate more free cash flow and more value for the firm because your cash is not tied up. You don't have a bunch of cash sitting in the bank account that's not earning value for you. You don't have a bunch of things in the warehouse, in the inventory shelves that are not earning value for you. And if you can decrease both of those, then that's going to increase your free cash flow. And do you remember how that math works? We have a decrease in those current assets. It's like a decrease in current investment and operating capital. So I used the example, suppose we spend $1 million on a building. All right, that doesn't show up on our income statement, but that decreases our free cash flow. So suppose we spend that $1 million on the building, but at the same time, we get $2 million out of inventory. We decrease $2 million of our inventory. We say we don't need it just sitting around. Right? That will result in a positive $1 million to our free cash flow. So the restricted policy is going to generate more free cash flow based on the math that we already know and just based on the intuition. We have less assets sitting around not working for us.
That works sometimes. It's like for us, we give, I have dealers that have all this inventory. And, they could have 300-400 cars in inventory that they're paying interest on that might not be sold for 60, 90, 120 days, which kind of ties up their cash flow because they have lines of credit.
Yes.
But the problem is that we as the manufacturer are forcing. So if a dealership wants to have a restricted policy and kind of run a lean ship, they can't because we come in and say, you have to buy 100 cars from us.
Okay, all right.
So it gets a little, you have dealers that are trying to run very lean because the grosses on the vehicles are not very expensive, they're not high.
Okay.
But, we'll come in and say, you have to take, in December, 10, Nissan 300Z convertibles in December.
Okay.
You're not selling convertibles in December, it just doesn't happen, but
Okay.
that's just how we produce them, we have to get rid of them, and the dealership is going to just have it for 6, 7, 8, 9 months.
Okay, so that's something you would take into account if you're a financial consultant telling a firm how to increase their free cash flow. You can say, well, Bill's going to knock on your door and say you have to buy these in these increments at this time. We can't change that. But what we can change is all this cash we have sitting around. So if we go to a more restricted policy, we can increase free cash flow, increase value for our firm. Next question I have for you. Why might that be a disadvantage, besides you don't have a choice? Why might a relaxed policy be important? Why might that be useful for your company?
I think of a company that's in like a volatility market, so it's really volatile, so they need the current assets in order to pay for current liabilities or anything. So having a large amount of current assets would be good.
Volatility, yes. So you might need to all of a sudden buy a bunch of inventory, right? So you need cash lying around. You might all of a sudden have a bunch of people who want to buy certain cars or certain things. So it might help you to have a large pool of inventory. So a relaxed policy is going to give you more flexibility. A restricted policy is what we want to get to if we want to increase value of our firm, but only in a way that makes sense business-wise. You'll weigh those two things. You'll say, let's make this policy more restricted, but let's make sure we're doing it in a way that makes sense. All right, so relaxed versus restricted. Okay, let's ask this question on cash. Cash is a current asset. We already mentioned if we can get as little of it as possible in our bank, that helps our lean operations and increases our value. Plus, cash doesn't earn any interest when it's just sitting in our bank, but we need it for some reasons. And I'll just throw out some reasons. I'm sure you could have thought of them without me pointing them out, but you need cash for various things. You need cash to pay for things. You need cash, precautionary balances just in case, safety, trade discounts, which we'll talk about later. If a supplier says, if you pay cash for this right now, I'll give you a discount. So having cash on hand is good. And compensating balances. Suppose you need to take out a loan for one area of your business, and the bank says, well, you need collateral. We can say, well, we've got a big chunk of cash in our bank account. So we've got that just in case.
We do. We have what they call CMA account cash, and it basically, I have dealers that have $5, $6, $7 million in this account, but it offsets the interest that they pay on their and the interest on the cars on their floor plan. So
Okay.
dealers will take this money, dump it into this account, and then it offsets, the loan. that they
Is it just collateral?
It's called a cash management account, and
Okay.
so if a dealer has $20 million worth of inventory, and let's say their interest payment a month is $90,000, the interest they might pay $40,000 because the interest that we're paying them for their money that's in this account with us offsets the interest that they're paying. So it's kind of like an even wash, and
Okay.
we have their money to use for buying things, and they're getting a discount off of their monthly expense on it.
Okay. Sounds good. Sounds complicated, but
A little bit.
all right. Now, we need to keep all of this in mind, that we need cash for various things, but what might we do to minimize our cash balance? Because remember, the name of the game tonight is decreasing these current assets. The one thing I want you to remember, if we decrease current assets, we increase our cash flow, we're a more lean operation, and we add more value. So what could we do to minimize our cash balance? Take a look at the notes if you want. You could just throw out some ideas.
Increase forecast accuracy.
Yeah. Figure out how much we need in advance. So we can plan ahead. We don't need a big lump sum of cash just waiting for a rainy day. We know when we'll need it, why we'll need it. Match those inflows and outflows. What else? What else can we do?
Hold marketable securities.
Yes, what are marketable securities, Mallory?
Somebody help me.
They're just
Stocks and bonds and stuff like that.
specifically, they might be things that you could sell easily. So if you need cash right away, you could go to the market and sell this quickly. So you're earning some rate of interest. It's an investment. So an emergency comes around, you can sell it and get the cash.
So security, selling stock or something.
Something you could sell easily.
Okay.
Alright, so you don't want it sitting in cash because we want to decrease our cash, but we want something there with a little safety. So we have this thing we can sell right away if we need to. Range lines of credit. Go talk to the bank. Say, hey, just in case I need a loan, would you be able to provide it? How much? Boom. Okay. Now I can get to that leaner operation and I've got a line of credit if I need it. Use discount and credit periods. This means, we'll talk about this later. Discount period, if a supplier sells you something and says if you pay within 10 days, I'll give you a discount, then you pay within 9 days. You don't pay on day 1, you pay on day 9. Use that discount period. Furthermore, if a supplier says, and if you pay within 40 days, then you'll pay this much. And you use that credit period, you pay on day 39. You don't pay on day 1. Use those periods. Use lockboxes, wire transfers, automatic debit for customers. Things to increase the cash flow from your customers. You want to make that as efficient and as quick as possible. And I think there's a lot of opportunity if you all find yourself in a consulting position where you're trying to help a company increase their value. Some of these things may sound very obvious when we're talking about them now, but a company could easily miss some good opportunities to make that cash income come faster. All right, question. How are we going to finance our assets? We've talked a little bit generally about working capital management. We want to think about how we can manage this working capital. I liked this graph in your textbook, so I stole it. And it gives us a look at certain assets a firm might have, certain fixed assets. Current assets, meaning the things we're talking about, inventory, cash, receivables, that are permanent, that you're going to have in a good economy, bad economy all the time. And then there might be temporary assets, such as you might need a little extra cash for a certain season. You might need a little extra inventory if you're expecting a run on a certain product. And these temporary assets are going to fluctuate. And we, as finance folks, are going to think about how we're going to finance that. In the past, when we've talked about how we want to finance something, we've asked the question, do we want to finance it with debt or equity? Tonight, we're going to ask the question, do we want to finance this with long-term financing or short-term financing? So we'll look at three different options, three different ways we could finance these assets. The first is the moderate, also known as the maturity matching system of financing assets. And this essentially says, if something is permanent, we want to finance it with long-term liabilities, long-term stocks, long-term loans. If something is temporary, we want to finance it with short-term loans. So if we're going to need a little extra inventory, and we want to keep it as lean as possible in the times when it can be small, right, then we're going to not have that short-term loan on our books. But if something happens, we need to increase it right away. Let's go get a short-term loan. And we're going to match the way our assets are set up with the way our liabilities are supporting those assets. Maturity matching, moderate. Now, we could take what finance people consider a more conservative approach and say, hey, you know what? We know we're ultimately going to need these temporary current assets. Throughout the course of the year, we may need larger inventory. Let's plan ahead, and let's finance everything with long-term liabilities. Everything with long-term stocks, long-term loans. Your textbook calls that a more conservative approach because you never know when you may not be able to get a loan. You never know when interest rates may increase. Your textbook used the example of 2007 when the financial crisis started, and companies that did not have access to loans already lost opportunities because no one was lending. No one was giving them a short-term loan to increase their inventory. So opportunities dried up because they hadn't thought about a long-term strategy and taken a conservative approach. That's not to say this is always the approach you should have, but that is the conservative approach. What your textbook calls the aggressive approach is financing both temporary assets and some permanent assets with short-term loans. We take loans on a short-term basis. They roll over faster. Sometimes it gives us more flexibility, but it also can put us in a more risky situation. If all of a sudden interest rates go up, all of a sudden we don't have access to that capital. So, aggressive approach, short-term loans, finance all temporary assets, and even some permanent assets. I've mentioned this already, but let's talk the advantages and disadvantages. Or, I've got these three on the next slide. Definition of maturity, moderate financing option, conservative financing option, and aggressive financing option. So just understand those. And then the one thing I want to talk about, or just sum up, already mentioned, some advantages.